The Canadian market has had a good year, rising more than 22%. But can that run continue into 2025? Joining us now to discuss is Michael O'Brien, Managing Director and Head of the Core Canadian Equity Team at TD Asset Management. And Michael, thank you very much for joining us.
Yeah, thank you very much for having me back, Anthony.
So as I mentioned, it's been a fantastic year for Canadian equities. What's been working so far?
You know, it's been a fascinating year because at one point or another, just about everything has worked. Been a whole lot of passing of the baton. So if you think back, earlier in the year, the commodity space was quite strong. Energy in particular had a really nice, first quarter or two of the year. That's kind of cooled off, but then you've had the financials, which have pretty much been strong start to finish. Your banks, your insurers, your asset managers, very strong. Q3, when we finally started to get central bank rate cuts, you saw a lot of the interest-sensitive sectors like your REITs and your utilities perform very well. Golds have been very strong lately. So it's been interesting. We heard a lot of talk earlier in the year about a narrow market south of the border. I would say this has been a pretty broad-based strength. So, at any given time, one sector's working a little bit better than the others, but the entire time, the market just keeps moving higher and higher. So it's been a very good year for Canadian equity.
Okay, so those are some of the things that are working. Talk about the parts of the market that haven't performed quite as well. What are we seeing there?
Sure. Well, I would, like I mentioned earlier, the commodity space. If you look from start to finish, it's been a pretty respectable year. But really, the commodities, and particularly the oil and gas producers, have been a little soft in the second half. I think when you look to why would that be? The two things that changed sort of mid-year, first of all, it kind of dawned on people that, we're not seeing the growth we're used to out of China. And China is such an important player in the commodity market. So I think, that sentiment around, weaker demand, not so much here in North America, but, China particularly, that's kind of had an impact on a lot of the commodities, like I said, oil and gas in particular. And then the second part of it too, when the market switched from inflation is high, interest rates are high, to we're in a cutting cycle and inflation is no longer a problem, the commodities tend to be more of an inflation hedge. And so I think people sort of shifted gears and looked to the areas of the market that benefit from lower inflation, lower rates, things like technology stocks, which have had a very strong second half of the year.
Okay, so let's talk about some of those stocks. As you mentioned, interest rates are coming down. Talk about those interest sensitives, technologies as well, as you mentioned. What are you seeing there? Yeah,
well, technology is, they certainly benefit from lower interest rates. That's more of a pro-cyclical, if you're playing offense. They've clearly responded. Lots of exciting themes throughout, the technology world.
We've certainly heard about the AI theme. That has been a big theme going forward.
Absolutely. So that's been, the narrative, as they say, has been, very supportive of that area of the market. Then, what's interesting, if you flip to other interest-sensitive parts of the market that you would traditionally think of as more defensive, things like your utilities, your pipeline companies, your REITs, it's been a bit of a mixed bag there. If you look at your classic pipeline companies like Enbridge and TC Energy, the big yielders, they've had a phenomenal year. On the other end of the spectrum, if you look at communication services names like BCE and TELUS, they've really struggled. And that's a lot of people would say self-inflicted wounds where, the competition in wireless and wireline very, very strong. So, that's been an area that has not participated. So it really depends on, which segments of the market. But, by and large, the rate cutting cycle that we saw kick into gear, mid-year here in Canada, and by all accounts should continue, heading into 2025. That's certainly helped those, those interest-sensitive areas of the market that don't have that self-inflicted baggage.
Okay, so that's a backdrop heading into next year. How do you think things might play out for Canadian equities as we look ahead to 2025?
Boy, that's a really interesting question. So I think what I would say is, the starting point here in Canada, valuations are reasonable. South of the border, again, a lot of enthusiasm. South of the border, valuations look a bit elevated, so it's a little more challenging starting point. If I look today, looking out to 2025 expectations, we're basically right in line with historical ranges in terms of valuation multiples. So that's not an inhibitor, in and of itself. Within that, though, there's an expectation that things are going to get better, I guess would be the way to put it. Put another way, there's a lot of momentum expecting positive things to happen in 2025, both north and south of the border.
Particularly after the post-election, we've seen that euphoria.
Yes, we've seen a real surge. And so the thing that keeps me up at night, to be honest, is these bull markets can breed complacency. And what I mean by that is you come into work, you read an ugly headline in the paper, markets go up anyway. You come in the next day, another ugly headline in the paper, markets still go up. And pretty soon you get to expect it. You get a little complacent and you stop looking under those rocks to see what problems are out there. What I worry about is that potentially the market could be a little too complacent as we go into 2025. So I'm trying to be vigilant, because when you step back and think about the world as we head into next year, there are an awful lot, the range of outcomes is very broad. There could be a lot of very positive things that happen, like you said, with the new Trump administration coming in. Investors certainly south of the border are optimistic that, this means deregulation, easier environment for, small businesses, for example, tax cuts, all positive things for the markets. But it's just as easy to envision some negatives out there. And, we've seen that with the 25% tariff headline, Canadian and U.S., imports. So all of these things are possibilities. What does keep me up a little bit is after such a strong surge in the market, we've come so far, like you said, up, 22%, 26% total return. It's not as low a bar to hop over. So I think we have to be vigilant that the risks here are two-sided. Things can go right, they could also go wrong. So I think we want to be level-headed about it.